Let me start with a simple question. If I handed you $1,000 today and told you that what you do with it over the next year could shape your financial life for the next 30 years, would you treat it carefully or casually? Most people think $1,000 is too small to matter. That's a mistake. Because it's not the amount that changes your future, it's the habit you build with the first dollar you invest. In 2026, investing is louder, faster, and more confusing than ever. Everyone has an opinion. Everyone promises quick returns, but the truth hasn't changed. The smartest way to invest your first $1,000 is the same way people quietly build wealth year after year, by being patient, disciplined, and clear about what you're actually doing. Today, I'm going to show you how to think about that first $1,000. Not how to get rich fast, but how to get started the right way. When you invest your first $1,000, the money itself is not the most important part. What really matters is what that decision does to you. This is the moment where you stop being someone who talks about investing and become someone who actually does it. And that shift changes how you think about money forever. Most beginners fixate on returns. They ask, what if I lose it? Or, what if I could have made more somewhere else? But those questions miss the point. At this stage, the goal is not to maximize profit. The goal is to build the behavior that will allow you to invest consistently for decades. A perfect investment made once does very little. A reasonable investment repeated year after year can quietly change your life. Your first $1,000 teaches you how you react when the market moves. When it goes up, you learn how tempting it feels to believe you're smarter than you are. When it goes down, you discover how uncomfortable uncertainty can be. Reading about market swings is one thing. Watching your own money move is very different. That experience cannot be learned from books, videos, or advice. It only comes from participation. This is why small amounts are powerful. Mistakes made early with limited money are cheap lessons. You learn not to panic when prices drop. You learn that short-term noise is constant and long-term progress is slow but steady. You learn that doing nothing is often the hardest and smartest decision. Over time, this behavior compounds just like money does. You become more patient. You stop checking prices every hour. You start thinking in years instead of days. That mindset is what separates people who stay invested from those who jump in and out and never build momentum. If your first $1,000 grows, that's great. If it struggles, that's also valuable. Either way, it gives you something far more important than a quick win. It gives you confidence, discipline, and a clear understanding of how investing actually works in real life. And once those habits are in place, the size of the investment stops being the limiting factor. When you're starting out, complexity feels comforting. It gives the impression that someone has figured out a secret you don't know yet. Charts with dozens of indicators, strategies with complicated rules, and investments that take 10 minutes to explain all sound impressive. But in reality, complexity is usually a warning sign, not a strength. Simple investing works because it leaves less room for error. The more moving parts you add, the more decisions you have to get right. And most people don't fail at investing because they lack intelligence. They fail because they make too many decisions under pressure. Simplicity removes that pressure. It gives you a clear plan that doesn't change every time the market does. There's also a cost to complexity that rarely gets talked about. Complicated investments are harder to understand, harder to monitor, and harder to stick with when things go wrong. When you don't fully understand what you own, every market drop feels like a threat. That's when people sell at the worst possible moment, not because the investment was bad, but because it was confusing. Simple strategies make it easier to stay calm. You know what you own and why you own it. You're not reacting to every headline or social media post. You're not second-guessing yourself every week. That mental clarity is a real advantage, especially in a world where information never stops coming. Over long periods of time, the gap between simple and complex approaches becomes obvious. Simple approaches tend to be consistent. They may not be exciting, but they're reliable. Complex approaches often promise higher returns, but they rely on timing, precision, and constant attention. Miss one step, and the whole plan can fall apart. Your first $1,000 is not the place to experiment with clever ideas. It's the place to build trust in a process you can repeat. The best investing plans are the ones you can explain in one sentence and still feel confident following when the market tests your patience. When you keep things simple, you give yourself the best chance to stay invested long enough for results to matter. When you invest, you're not buying symbols on a screen or reacting to daily price movements. You're buying a share of a real business. That business sells products or services, pays employees, competes with rivals, and tries to earn a profit over time. The moment you forget that, investing turns into speculation. Headlines are designed to grab attention, not to help you build wealth. Every day there's a news story predicting the next big winner or warning about the next collapse. If you invest based on those stories, you're letting emotion and noise drive decisions that should be grounded in logic and patience. Headlines change quickly. Businesses, when they're well run, create value slowly and steadily. Owning businesses shifts how you think. Instead of asking, "What will the market do next week?" you start asking, "Will this company still be relevant in 10 years?" You think about customers, competitive advantages, pricing power, and whether the company can adapt as the world changes. Those questions don't have exciting daily answers, but they lead to better long-term outcomes. Markets will always swing. Prices will move for reasons that have nothing to do with the actual health of a business. When you understand what you own, those swings become easier to tolerate. A temporary drop feels less like a crisis and more like background noise. You're focused on progress, not popularity. This approach also protects you from chasing trends. Popular investments often look safest right before they disappoint the most people. When everyone agrees something is a sure thing, the future returns are usually already priced in. Businesses, on the other hand, don't need hype to succeed. They need customers, cash flow, and sensible management. Your first $1,000 should introduce you to this way of thinking. It should teach you to separate value from attention, to ignore excitement and focus on durability. Over time, this mindset helps you avoid the biggest mistakes investors make, buying what's popular and selling what's temporarily uncomfortable. When you own businesses instead of headlines, you stop reacting and start investing with intention. No matter how smart you are or how carefully you research, investing will always involve uncertainty. There are things you can't predict, events you'll never see coming, and outcomes that don't follow logic. Diversification exists for that reason. It's not about maximizing returns. It's about survival. Most investors don't lose because they're wrong often. They lose because they're wrong once in a way they can't recover from. Putting too much money into one idea, one company, or one theme might feel confident, but it quietly increases the risk of a permanent setback. Diversification lowers the chance that any single mistake can do serious damage. When you spread your investments across different businesses, industries, or markets, you accept that some will underperform. That's not a flaw in the plan. It's the plan working. The winners don't need to be perfect. They just need to be strong enough to carry the overall result forward while the weaker parts fade into the background. This approach also changes your emotional experience. When everything depends on one outcome, every price movement feels personal. Stress increases, patience disappears, and decisions become reactive. Diversification softens those swings. It gives you breathing room. You're less likely to panic and more likely to stay invested when it matters most. Staying in the game is the real objective. You can't benefit from long-term growth if you're forced out by fear or by losses that are too large to recover from. Diversification helps you avoid those situations. It keeps setbacks manageable and progress intact. Your first $1,000 is the beginning of a long journey, not a single bet. Learning to spread risk early sets the tone for everything that follows. It teaches you humility, patience, and respect for uncertainty. Over time, that mindset compounds just as reliably as returns. Investors who last are rarely the boldest or the loudest. They're the ones who built systems that could withstand being wrong and kept moving forward anyway. In 2026, it's easy to believe that speed is an advantage. Trades happen instantly, news travels in seconds, and opinions change by the hour. But the one advantage that still matters most is time. And if you're investing your first $1,000, you likely have more of it than you realize. Time allows small decisions to grow into meaningful outcomes. It turns modest, consistent progress into something powerful. Compounding doesn't make headlines, and it doesn't feel dramatic in the beginning. In fact, it often feels slow and underwhelming. But over years, that steady accumulation begins to do the heavy lifting for you. Trying to predict the perfect moment to invest often leads to waiting forever. Markets reward participation, not precision. When you start early, you give your money more chances to recover from mistakes, downturns, and bad timing. Time smooths out errors. It forgives impatience and rewards consistency. Your first 1,000 may not feel life-changing, but what it represents is. It's the starting point of a habit that can be repeated many times. Each year you delay starting, you don't just lose potential returns, you lose experience, confidence, and momentum. Those losses are far harder to recover than money. Time also changes how risk works. Short-term volatility looks dangerous when you're focused on weeks or months. Over longer periods, that same volatility becomes less threatening. The ups and downs begin to look like background noise rather than signals to act. Time gives perspective, and perspective leads to better decisions. In a fast-moving world, patience becomes a competitive advantage. While others jump in and out, reacting to every shift, long-term investors quietly benefit from staying put. They allow businesses to grow, strategies to mature, and compounding to work without interference. Starting early isn't about being aggressive. It's about being realistic. You don't need extraordinary returns when you have time on your side. You need durability, consistency, and the discipline to let time do what it has always done best. Turn small beginnings into lasting progress. An investment only works if you can live with it. That sounds obvious, but it's where most plans quietly fail. On paper, many strategies look smart. In real life, they demand more patience, confidence, or emotional control than most people can maintain. When stress enters the picture, the plan breaks. The best investment approach is one that fits your temperament. Some people can handle volatility without losing sleep. Most cannot. If your investment makes you anxious, constantly checking prices or questioning every decision, it won't last. Eventually, discomfort leads to action, and action taken under stress is rarely the right one. Consistency matters more than brilliance. A strategy that earns decent returns year after year will outperform a perfect strategy that you abandon at the first sign of trouble. Markets will test everyone. There will be downturns, long flat periods, and moments when doing nothing feels irresponsible. Your ability to stay committed during those times determines the outcome more than any single decision. Boring gets a bad reputation, but boring is dependable. Boring allows you to stay invested when excitement fades. It removes the temptation to constantly adjust, tweak, or chase something new. When your plan doesn't rely on frequent action, you reduce the chances of making mistakes driven by fear or overconfidence. This is especially important with your first $1,000. Early experiences shape future behavior. If your first approach is stressful or confusing, you're more likely to step away from investing altogether. If it feels manageable and understandable, you're more likely to continue, add to it, and let it grow. The goal is not to impress anyone or to tell a good story. The goal is to build something that quietly works while you focus on the rest of your life. The right investment is the one that allows you to sleep well, ignore the noise, and stay committed when patience is required. Over time, that discipline becomes your greatest asset. Let me leave you with this thought. The future isn't built in dramatic moments. It's built quietly, through small decisions made consistently over time. Your first 1,000 may not feel powerful today, but it carries more potential than most people realize. Not because of what it can earn this year, but because of what it teaches you to do next year and the year after that. You don't need perfect timing. You don't need special insight. You don't need to predict where the market is going next. What you need is a sound approach, patience, and the discipline to stick with it when excitement fades and headlines get loud. If you treat investing like a long-term partnership rather than a short-term opportunity, you put the odds in your favor. You allow good decisions to compound, not just in your portfolio, but in your thinking. Over time, that mindset becomes far more valuable than any single investment. So when you walk away today, don't focus on doing something impressive. Focus on doing something sensible, something you understand, and something you can repeat. If you do that with your first $1,000, you won't just be investing money. You'll be investing in a habit that can serve you for the rest of your life.